The M&A IPO market is just sort of fraught with uncertainty right now. So I call it the wait and see economy. And there are a variety of reasons for that. Uncertainty is certainly the rule, not the exception. Across the economy, across public policy, and the global markets, no one factor dominates at all. In fact, it's a convergence of many economic shifts, evolving fiscal policy, trade negotiations, geopolitical tensions, and technological change. So every day, I think, who here spends more time turning on CNBC or paying attention to the news, certainly since the last administration, this recent administration came in, than before? Everybody? A lot of people. Yeah, every day we wake up and watch CNBC to see what has changed. I'm going to read a presidential tweet from today in a minute. Few examples. Tariffs. April 2nd is what the president called today National Liberation Day, which is when the next round of and point of view from the administration comes out on tariffs. So we wait. Sort of a fog of a trade war, really. Tax policy, we wait. Reconciliation process this year, probably in the second quarter, could end up going to the third quarter. You know, the impact on the consumer, the impact on business, the impact on small business. Inflation, today the Fed kept rates consistent. They had an outlook for 2025 that brought down GDP growth to 1.7%, just from just over 2%. And you know, while inflation cooled year over year relative to January, the expectation is that inflation will rise. So will the Fed raise rates again? We wait. The markets after the Trump bump post-election, the NASDAQ, the Dow, the Russell have all come off materially. I would argue that depending on what happens on April 2nd, we could see a next wave, and we can get into tariffs in a second with the panel, whether folks view them as structural or temporary. And then you add to that, which we'll talk about, there's tons of capital on the sidelines. In fact, private equity have been buying up and putting capital to use much more swiftly than they've been exiting and providing capital back to LPs. So there's a ton of waiting on the sidelines for the right opportunity, the right pricing, the right signals. And then M&A teams, I would argue, and we'll get into this, I would argue that M&A teams are spooled up. They're ready. They've been sitting on the sidelines for 2 or 3 years, wondering, sort of if they're really going to get at it and pull the trigger on a bunch of deals. But still, they wait. So when you put all this together, you get the wait and see economy. I just want to read on tariffs the tweet from today. The Fed would be much better off cutting rates as U.S. tariffs start to transition, ease their way into the economy. Do the right thing, Fed. April 2nd is Liberation Day for America, right? And so the reason I read that is that if you are trying to put capital to work, you really don't know what market you're putting capital to work in, and that'll play out over the next couple of quarters, hopefully sooner. So as we transition into 4 slides, consumer sentiment is deteriorating at an alarming rate. This is across all income levels. People are worried about job loss. People are worried about inflation expectations, et cetera. This is out of the University of Michigan study. Yeah, I'm from Ohio, so. Ohio State, my wife went to Ohio State. There's always who was that? Oh, it was Blake. Yeah, man, what's up? I'm always jealous of University of Michigan. Small business uncertainty at its all-time high since the survey started in the 1970s. This is from a super credible organization, the NFIB, that is a big lobbying group in D.C. That represents small business. So now pivoting to M&A and the IPO market specifically as a tee-up for the panel. If you look at this chart and pay attention to the red line, this is from Bain. By the way, for those of you out there, Bain does a great report annually. It just came out, both on the M&A market and also PE. It's a great read. So this is one slide from that report. And the basic point is that global M&A value as a percent of GDP is at the lowest it's been since 1995. So there's just a ton of pent-up demand to go put money to work, and the outlook is incredibly foggy for the reasons I mentioned. And we'll get into folks' view in 2025 here shortly. If you look at the IPO markets, sort of a similar, if you just take out 20 and 21 for a second, there was a lot of optimism coming out of a really dead period in 22, 23, and 24 in the IPO markets. Blake in particular, who will be on the panel, will talk about this, but there's a lot of preparation in the IPO markets today in terms of IPO prep, and his firm advises and works with companies considering an IPO. So as a final thought, what I would ask you to think about as we get into this is what are the most strategic moves being made now heading into 2025? And then in 6 or 12 months, do we really think that right now will be sort of a seminal moment? And I think it will be. I think we're going to get through April or May, and then the markets will open up. We'll see, though. We shall see. So with that, I would like to invite up Keith and Blake to join me. Clap, 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 clap. Gentlemen. You're sitting the opposite of your pictures, by the way. That's the problem.
Just to confuse people.
Thank you for being here. Ramp's World Headquarters. Much appreciated. Why don't we start with brief intros? Keith, you want to go first? Blake, and then I'll do a brief intro as well.
Sure. Keith Campbell, senior partner. I'm based out of Chicago. New York is my home away from home. Been at West Monroe for about 20 years, industrial engineer by trade, and got into the M&A business about 12 years ago, mostly focused on private equity, a little bit of corporate M&A. And I'm an industry mutt these days. I see all types of transactions across various sectors, so I have a kind of a broad view on deal activity. And for those not familiar with West Monroe Partners, we were part of Arthur Andersen, the world's largest accounting firm, and started in 2002.
Used to be,
yes, sorry. And we were kind of the technology components of Andersen, our founders. We took private equity investment 3.5 years ago from Michael Dell and his family office, or about a couple thousand people in the US and Europe. And from a private equity standpoint, we see about 600 transactions a year and serve 54 of the top 100 PE firms, 9 of the top 10. So most of the firms we're working with are kind of the $1 billion plus funds working on kind of core middle market transactions. So a little bit about myself. And I'm not a RAM customer. I am working on convincing our CIO and the global
so
features.
Am I.
The global features that were discussed today is really important for us, and as well as professional services workflows were a little complicated on the approval side. So I'm championing it and working it internally.
Any before we go to Blake, any in particular sectors you focus on, or is it pretty wide?
Tech has been a big focus for me the last 5 years as PE started gobbling up software companies. I also think it's just very interesting as an engineer and coder in the early days of my career. But tech and healthcare are probably the two that I spend a lot of time on, and a little bit of kind of what I call the essential services space, which we'll talk about later.
Great, thank you.
All right. Blake Collins. I'm a partner at a firm called Connor Group, and we are kind of a specialized accounting firm headquartered in Reno, Nevada, randomly. Actually, headquartered in the Virgin Islands, technically. But but we're primarily Big Four, former Big Four professionals, industry executives, and we provide a variety of services across the board in relation to accounting and finance. And just at a very high level, we do system and technology implementations. We do operational accounting assistance for companies that need that type of assistance. We do a little bit of M&A. We do financial operations, more like controls and process improvement type stuff. And my service line that I focus on in particular is technical accounting and IPO services. So I'm a CPA. I guess I'm like kind of the nerd of the the cool M&A guys up here. But yeah, that's what I've been doing. I've been at Connor Group for the past 8 years. And as I said, with my service line, Connor Group really started out doing IPOs. Started out of the Bay Area where our founder was involved in the Google IPO, and realized that there was really a hole in the marketplace with companies having to do Sarbanes-Oxley and things like that, and just didn't really know what they were doing. So he started this practice, and it just took off from there, and then we've expanded into other areas. But over the 18 years that Connor Group's been around, we've done over 250 IPOs. And as you saw in the chart that Guy was showing, like you saw that huge spike in 21 and 22 on the IPOs. And I think just during those couple years, we almost did like 100 IPOs. So just to kind of give you an idea of like how much IPO activity was concentrated in that tiny amount of time. And it was just a crazy couple of years from an IPO market perspective.
By the way, just spot on that. What drove those 2 years? We're gonna hit on 25. Do you have a point of view as to what drove that? Because it's instructive.
Definitely. So I kind of refer to it as like an IPO roller coaster in a way, the last 6 or 7 years, because you basically had like kind of I think of Charles Dickens, where he's like the best of times and the worst of times, and that was literally like the IPO market, where you had 21, 22, which was historical levels of IPO and fundraising. And then it just plummeted. And I think that, what was the year? 8.6 billion of capital raised in 23, which compared to like 157 billion in 22. So it's just this massive tank in IPO activity. But I think what drove that really is that, well, for one, it's COVID, because the market was relatively normal pre-COVID, and then you hit COVID, and things really just like came to a shut. I remember thinking myself, I was like panicking, and I'm like, the economy is just going to crash. Like, people can't afford to front like a month of living if they're not going to be working or whatever. And I think a lot of people had those same expectations. And but then like within a month or so, all of a sudden you saw all this capital come into the marketplace and just cash. And valuations went nuts, and I think it was like, from my perspective, I think it was a lot of like FOMO in a way. So investors were like, I've got to get into this market, and I'm going to pay high valuations regardless, because I'm going to miss out if I don't. And so investors, I think, were looking at like revenue growth, like almost solely revenue growth as their metric for what a good company was. And the basics of a business model were almost like thrown out the window, where it was like that no one really understood whether these companies could ever get to a profitable state. And we saw a ton of that with some of our clients, where, well, some of our clients and other companies as well. I mean, you had SPACs that came into the picture, and turns out they weren't that great of an idea. But you had these SPACs come in, and there's these companies that had really like no intention to go public, and then 4 months later they were public through a SPAC.
SPACs might have been one of the worst ideas from an aggregate point of view.
Yeah, and I think the SEC's tried to basically kill SPACs for the most part. We still see a little bit of SPAC activity, but not to that level. But yeah, like you get these companies that were operating under this grow revenue at all costs type model. And then you get to 22, and the PE firms are like, oh, we actually want to see some profit. And these companies didn't know how to get there, because they weren't prepared to run as a public company. And I think that's what shut the market down at the end of the day, because the investors started saying like, well, where's all the companies that have a good model and a clear path to profitability that they can demonstrate to us? And all those companies that maybe if they would have had a couple more years to prepare, they would have been in that position, but they were all part of that spike in 21 and 22, and it kind of took all the supply out of the market of public ready companies in those 2 years that should have been really spread out over like 4 years or 5 years.
Yeah, I mean, the cost of capital was pretty cheap at that point.
Yeah,
so,
yeah, exactly.
So let's go to 25. Let's just take that as context and go to 25. Keith, maybe you start. I mean, you're involved in an immense amount of transactions. Your team is, your global team. Like, what is your sense for, I mean, you heard my intro. What's your sense for this year's market? I mean, there's just a lot of capital sitting on the sideline, waiting to be put to work, a lot of uncertainty. What do you bet for 2025?
So I stopped listening to the bankers because I feel like for 3 years they've been telling us their pipeline's full and be prepared. So we're no longer falling for that. In terms of what we see in our deal view, as I was doing my business review yesterday, our sell side activities up is doubled in 2.5 months compared to last year.
Sell side.
Yeah. So, those things will hit buy side auction, late April, early May. Those deals start closing in Q3. Again, it's a small view.
Yeah.
The actual, deal count, I think the Bain chart's interesting when it's deal value. You can kind of really get a couple of mega deals like a Wiz. And skew things, we look more on the transaction count as maybe a healthier metric of what's actually going on. And January was the lowest month of PE market, minimal market deals getting done in 14 years.
Is that right?
Yeah.
Holy smokes.
That was PitchBook stat. That's not our stat, but yeah.
Yeah. Wait, so January
was the slowest in 14 years.
Okay. Do you have an idea of what's in February or March yet, or no?
I don't think the PitchBook report has come out yet, but I think just generally what we're seeing, our buy side stuff is down maybe 5-10%, but the sell side really
do you think that's
propped it
just a
up.
delay? People are prepped, and it's a delay.
Yeah. So the good assets are trading, and there's tons of competition. So just from like a sector standpoint, if we wanted to get into that at all, I could touch on that. Just kind of what we see, what's hot, what's not. In terms of what's trading in good businesses, healthcare, IT, again, pretty resilient, mostly focus on, U.S. economy, generally stable from a regulatory picture. I mean, we'll see what kind of happens with Medicare and RFK and the MAHA stuff, as we don't really know yet. But I think good healthcare IT assets are trading. ModMed just traded last week. That was one that has always been a little bit of a darling on the EHR software side. So healthcare IT, things dealing with clinical data, really hot, just from evaluation and PE interest. What else is hot? I call it essential services. So things that are trades, HVAC, CPA firms, things that have a better entry multiple, right? These things are trading 8 times to 14 times EBITDA, not the software multiples. They're reoccurring they don't have tariff exposure because they're mostly U.S. And there's a massive opportunity to drive productivity with AI if you actually go through the buy and build strategy. So those things are enormous amounts of capital going in right now.
Anything? Just one more for you, Keith. Any differentiation in size? You hit on sector. Is it, or do you? The big companies get all the news, right?
Yeah, exactly.
So it's really hard to tell what's in the market.
A lot of the take privates, like you talked about, Blake, I think a lot of the take privates were kind of picked at the last 2 years, right? The stuff that was public, that wasn't growing, wasn't profitable, and they, got taken private by the Thoma Bravos of the world to get healthy and get out of the public eye. I feel like a lot of those good ones have been picked off.
Yeah. So let's transition to IPO readiness. If you wouldn't mind, just sort of relatively briefly describe what IPO readiness is. Yeah, and what is involved in that, and sort of put a CFO hat on, and then maybe sort of parlay that into sort of the volume you see, and any point of view coming into the back end or middle or back end of 25.
Yeah. So IPO, right? It's such a broad topic because when you're talking about that, you're not talking just about accounting and finance, which is what I deal with, but you're also talking about like legal and investor relations and executive compensation and all these other areas. So there's a ton of things that you have to think about from an IPO readiness perspective. But I think the easiest way to think about it is, I mean, we do IPO readiness assessments for companies, and so we'll go in and kind of with a fine-tooth comb and really look at like, here's all the things that a typical company needs to be ready for, and then we tailor that to that company and say, here's your roadmap that has all the kind of things you need to think about, and then you can figure out, and then you need to figure out how to balance what to do now versus what to do later, because with this whole waiting game that we've been talking about, there's so many companies that they don't know when to start preparing, because it's like, who knows when the window's going to be
how long?
right,
How long of a time to prepare?
I would say
Depends,
the
right? You're never ready.
general
You're never
framework.
ready.
Yeah, you're never ready. Like the general framework is like 12 to 24 months that we tell people. So
Kind of convenient.
yeah, I know that's definitely like not a one size fits all type thing, because some companies realistically, like, they're pretty buttoned down and they could go public within like less than 12 months. But I would say the large majority of companies need at least 12 months, and a lot more than 24 months even to start thinking about it. But the way that we kind of frame IPO readiness to our clients is, and again, this is strictly from a finance and accounting perspective, but we kind of give them 4 main goalposts. And the first one is like, you need to think about what periods you're going to need to present in your financials when you do go public. And those financials need to be audited. You need to have all your quarterly reviews done, which that's a key one that a lot of companies actually underestimate, because we come into a lot of companies and they're like, no, we're good on the quarters. Like, we've got a pretty good process. But then when it comes down to it, you start digging in and it's not good. So like, there's a lot of work that needs to be done a lot of times on quarterizations. So that's one. The second one that we talk about is you need to be able to close your books within 10 days. And the reason for that is because if you can't do that, and I don't just mean like close your books and then like 6 months later you're still posting like little adjustments. Like, you need to be to a point where you've closed your books and there's no post-closing adjustments, there's no audit adjustments that come out of the audit, and you really have good processes in place to like be comfortable with your closed books. And there's a ton of work that goes into that one. So that's obviously, like, these are all very high-level milestones. Another one is like, it's always good practice to kind of have like your S1, the document you file with the SEC, prepared at least in relation to your F pages where your financials are. And then also like your management discussion and analysis section, which is a really critical section that I feel like gets overlooked and kind of gets placed at the last minute in a way from an IPO perspective. But that's where like if you're looking to pitch your company to an investor, like, they should be able to go to that section and be able to say like, okay, this is how management looks at the company, and here's the key performance indicators that they use. And here's how I can tell if this company is like on track and has a good growth story. So you need it takes time to kind of figure that out. And there's different people within the company that have very strong opinions on like what you should be putting in there. So like, it takes a lot of time to kind of balance all that out and really like fine tune that section. And then I know I'm missing one. I'm trying to think of, the last one is having a really good like budgeting and forecasting process in place. Because another thing you don't want to do is you don't want to go into an IPO and say, here's what we're going to be, here's our forecast basically, and like talk to the street and tell them here's what our earnings expectations are, and then you miss your first like quarter or whatever it may be. Because that's like, we've done studies within Connor Group, and when that happens, the stock price kind of tanks a little bit when you miss your expectations, and it takes a long time to get that trust back from the public to be able to get back to a price that you would like expect yourself to be. So you want to make sure that you really understand your numbers and are in a position where you're comfortable saying we can do this, and then actually like go out and achieve it so that you don't miss those targets. So that's how I like very high level define IPO readiness, and those are some good things to think about.
Yeah, a couple roles ago, I was at Ingram Micro. I joined Ingram when, as Keith, you know, when Platinum Equity bought Ingram Micro, and Ingram was previously a public company, and then they were sold to HNA, And then Platinum got a great deal off of H&A, it was a Chinese holding company, bought it really, really well, $7 billion deal, $2 billion equity check. And that was a previously public company. It's now back in the public markets as of a couple months ago. And even then it took a while to be ready, So do you guys, so let's come back to, we got taxes, tariffs, a variety of sort of activity coming out of the administration. As you look into is there any sort of unlock, right? Is there something that would sort of remove some of the volatility and uncertainty in the market, and therefore, teams, particularly CFOs, would be ready to roll, right? Either doing acquisitions, and or maybe a dual track to go, to sell and or into the IPO market. Do you see anything that would be, or a combination of things that would get us there? Because it's a real problem right now. It's a real problem in the market.
Particularly on the industrials.
Okay.
Consumer industrials is where we see their scenario planning right now, right? It's almost like when those of us that were in the field in COVID, when COVID hit, everyone's like, okay, what's my cash burn if revenue goes to nothing, right? And that's what all the private equity firms were figuring out. They're like, all hands on deck. So it's not as extreme, but those are like when you're doing diligence right now, you're modeling different tariff cases.
Right.
And trying to figure out what the risk-adjusted return
So you
could
say
be in
industrials
different
because
scenarios.
it's primarily supply chain heavy?
Yeah.
Yeah.
Yeah, and COVID got some of these companies thinking about supply chain risk management and scenario planning, so that they turned it up a little bit, but now this is I think cranking it on another level, because you just don't think about every, China and Mexico and Europe at the same time.
Are you seeing reshoring? Are you seeing some reshoring?
That's what the planning is going on right now. I think there's not a ton of middle market and private equity owned middle market now is saying, hey, let's just, do a bunch of CapEx build because they want to make sure they have the cash and are in the wait and see and plan the scenarios, but not right now building, other than, the things that you've seen with CHIP Act and other things that already have, government support on it.
Yeah.
Yeah, I kind of say the same thing. I mean, I think what it does is it just introduces uncertainty in the marketplace, and it's kind of the same issue as the post-COVID era, where the companies they weren't able to really know exactly how profitable they were going to be.
Yeah.
So investors didn't really know how to price a lot of these companies because they just kept burning cash and not really improving in a lot of cases. And I think a similar issue is happening with the tariffs, because it's just no one really knows how long they're going to be around for and exactly what it's going to how it's going to impact them. And so it's just one other level of uncertainty where investors have to I'm guessing you probably have to do a whole bunch of just models, almost like Monte Carlo type simulations to figure out what's the true risk of this company if this or this or this scenario happens. And then you throw interest rates on top of that, and who knows when those are going to come down. And you throw in there's so much stuff that's just going on, and it happens all the time. But I feel right now there's just even more uncertainty, to the point where it's just, I don't know, hard to know how it'll actually impact things. But it'll definitely delay things. And we've seen companies we have a list of companies that we work with that have IPOs in their plans, and we're kind of in different stages with talking through that with them and helping them think through that. And I mean, there's I don't even know how many companies are on that list, but probably 100 or so. But a lot of those companies have been on that list for 3 years, and they've been thinking it's going to be next year, and then it'll be next year, and it just keeps getting pushed back. So at some point, it'll get to the point where company expectations and investor expectations align, to the point where it does create that window where it's okay, now we're all comfortable with doing this, and let's do it.
Yeah. Sort of a provocative question, Keith. The state of play in private equity, call it 4,000 or so middle market-ish type sponsors across the country, an immense amount of capital to put to work. You just take 4,000 sponsors, let's say, 20 portcos per. It's a lot a lot of companies on sponsor-owned world. The dynamics are, it's almost a 2-to-1 in terms of putting capital to work versus returning capital to LPs. So LPs are, effectively saying that's enough. We're not going to be as ubiquitous in how we deploy our capital to GPs. So how do you think about, and I can comment too.
Yeah.
How do you think about sort of a reckoning in PE? Do you think there is one? Do you think there's a particular strategy that's more compelling than others? And take a crack.
People in the industry are calling it a barbell effect.
Yeah.
The big firms, the Apollos, the $20 billion plus firms,
That we all know. Yeah.
they can wait it out. They have no problem fundraising, right?
Yep.
Just given their track record and given private credit and how much that is just exploding.
Yeah.
So the big firms can wait it out. They have the dry powder. They're more insulated. I think the firms that we see kind of in the middle of the barbell freaking out are the ones that are kind of nearing end of their dry powder, and they're getting pressure from their LPs, and they're struggling to fundraise their next fund until they get the DPI and start giving some distributions on their portfolios. And those are the things that are going from average age of 4 years to now 7. And those firms will have a window where they have to exit and mark down. And just, this 2021 period is going to be like an asterisk on the IRR averages for these PE firms.
Yeah.
And so
Really
we are
hard.
starting
It's really hard
to
to
see
keep.
that.
It's really hard to kill a PE firm, though.
Yeah.
They have long fund.
Yeah, they draw
they
a long
drawn
time
out
to,
a long
to
time.
unwind.
Yeah. Time to unwind.
And there's good assets that they have, and I'm seeing this in a couple of my clients, like good assets that they have that they're going to be taking to market this year.
Yeah.
That they probably would have preferred to hold another year or two to get an even bigger exit, but because that LP pressure. So I personally see that with my deals, even my clients. I still do client work. I don't just speak at RAM panels, but so I think you'll see that in the middle of the barbell, and then on the smaller side, it's been crazy to see like people that are successful in a top 50 PE just go and launch a first time $2 billion fund.
Yeah.
That's happening, and so like individual track record matters, and these individuals are having no problem having a really unique or specialized thing that they're doing, whether that's sector specific or, private real estate or, just whatever that strategy is. And those individuals are not having trouble fundraising. So it's kind of the generalists in the middle that are struggling.
Yeah, it's kind of, I was just thinking about, that's basically how the SPACs work too, is like you have a SPAC that it's like, hey, this person knows this industry, so let's put a bunch of money into there and then he'll go out and find us a deal. And it's kind of the similar concept, but obviously PE I think is a better model for that, because SPACs actually, a lot of people were like, hey, this is going to be an easier route to go if we do an IPO, cheaper route, but it's not cheaper. It's actually like way more complicated, and it ended up like costing companies a lot more money to go through a SPAC than it did to just like go through a traditional IPO. So it was kind of a weird situation. But like to your point with the dry powder, you probably all know dry powder, but it's basically like committed capital to VC and PE firms. I was looking at a report the other day that said that they're at an all-time high right now with dry powder, and I think it's sitting at like $2.6 trillion of dry powder, like globally, that's just waiting to be put into an investment. And so it's definitely not an investor demand issue on the IPO market. It's just a supply side issues on companies that are ready to go public. So
yeah, it's one of those things where with so much capital, so few companies to buy, I would argue, just valuations are continuing to go up, which has caused firms to hire operating teams to think through efficiency, which I would argue is part of the growth thesis in the private equity world for Ramp. What are you seeing, Keith, in terms of valuations? Is that true, what I'm saying? Or do you
It is.
see something
I'll make it relevant to the audience because we've done like 85% of the CPA firm deals over the last, call it 18 months. So we saw them all, and well, almost all. And the first one that was done was, I think, like 12x EBITDA, and the most recent ones are trading like closer to 16.
Yeah.
And that's in less than 2 years.
What is this I don't know that. I don't know that sector well. Is this roll up? Is this consolidation?
Yeah, I mean,
is this
it's
sponsor to sponsor. What
every
is it?
regional accounting firm.
Yeah.
You know, the Cohn Resnick's that was just traded last week, and Grant Thornton's and Apollo put into BDO, and all the mid-market ones that are like specific to New York or Arizona, right? I mean, there is thousands of these firms.
And how much of this is quote unquote AI driven or efficiency driven, or do you think it's
so that's like what the headlines will say, right? Is labor shortage. Most of them are doing like, frankly, what happened in the 90s of just like trying to get some of their labor to India and Mexico, which I think is like
so offshoring, straight up offshoring.
Yeah, but that's like
labor
tables, like that's not hard to do. So I think I forget which of the influencers said it, but like the native AI firm, like that's exciting because you don't have like just the incentive legacy structure that's fighting you the whole way, right? And those are the ones that'll get 30 times. Yeah. So
I'm involved in the sports world now for the last few years. So when you think about leagues and teams, it's different. Obviously, it's different. But in terms of capital flowing in and multiples going through the roof, it's material. There aren't many more leagues to put money into. People are willing to pay up for the opportunity to get into that business and on a thesis that is perhaps much more broad. And so just interesting because a lot of money's flowing into live events, clearly. Do you guys do any work in live? Have you seen anything with like an AEG or, companies like that are in the live events or sponsor world?
Yeah, we Legends is a big player, which I think it was the New York Yankees.
Yeah, it was Steinbrenner
Dallas Cowboys.
Steinbrenner and Jerry Jones put Legends together. Yeah.
Yeah. So we were involved in some transactions around that, and it's cool because it's venue based, it's management of those, and so the PE firms will call that like the picks and shovels around sports and live events, and there's a lot of things that can happen with data and data science, right? If shares coming into town and you're trying to fill the suites, like take the ticket data that says your wife wants to go into a suite for $800, right? Like it's just there's really basic things you can do to improve those businesses. And
one of the things that I'm seeing a lot of right now, Keith, is stadiums that are going to be built that are sort of in that 5,000 to 7,000 seat range. That with kind of the on field allows you to get up to about 10,000 folks. And when you think about just think about sort of rectangular as opposed to triangle, baseball, soccer versus baseball. It doesn't really matter, but the rectangle's better. Not just because I'm a soccer guy. But it's the fact that you have both, I'll call it minor league soccer and women's soccer that are going to be, the NWSL will be somewhere about the 12 to 15,000 seat stadiums, bigger than minor league soccer, but perfect for those sort of medium-sized type concert venues for a circuit, for an AEG or Legends or even Levy who does the F&B.
Most of the big PE funds have kind of created sports investing teams, and then there's Arctos down in Dallas. They're a specialist sports firm.
Yep.
And then you got the Saudis, who want to put a lot of money in. I think Live is a bad deal. It's not working out. But how are they? Can they just burn that much money? I mean,
I
it's
think
insane.
I think it'll end up. I don't know about the economics. I think it's a really healthy strategy. I would argue for the sport, and I think that tennis is the next foray for full reinvention of the platform. And I think big money's going to enter tennis, and there'll be a lot of pressure on the four big events in tennis: Wimbledon, French Open, etc.
Maybe Serena will get into that. She's at Cancello Capital.
Yeah, she's there. Yeah. She's great.
LeBron with his pickleball team.
Yeah,
I guess that
pickleball does not make money. There's no money to be made in pickleball. There's really not.
I don't know. I see my wife's bar tab with the pickleball wives, and someone's making money.
I'm from the west side of Cleveland. I can't even think about getting onto a pickleball court. It makes me get hives, pure hives.
Yeah, the noise like clicking in your head as you
drives
sleep.
me crazy. So let's talk about volatility. I have an Aussie friend who talks about volatility as like a kangaroo. It's jumping up and down, jumping around, like the volatility in the market, right? I'll call it the market. NASDAQ, Dow. I would argue that, let's just call it 10% kind of correction rough and tough in aggregate. As an aside, maybe we can get to if tariffs become more structural. Like, I think this is all negotiators' theater, personally, coming out of the White House. It's just a way, because and that's just purely looking at the market, where if the market believed that we were going back to McKinley-style tariffs, which are big, permanent, structural tariffs, I think we'd have a downturn that's cataclysmic globally. I mean, would be a really bad situation. So even the market is saying, but it's still highly volatile. So back to the question is, when you look at, when you guys when you're talking to sponsors, you're thinking about IPOs and talking to your clients, how much are they paying attention to the volatility in the actual market itself or not?
So I would say from an IPO perspective, I mean, they do you do your road show right before you do an IPO to go talk to investors and figure out actual pricing. And they always have a pricing target that they're looking to get.
Yeah.
But to some extent, like, you're never going to be able to time that perfectly. Yeah. It's the same as if we are investing just in a random stock in the stock market. Like, you just don't know what's going to be one price, like the price from one day to the next. So I don't know that I think like the long-term projection of the market definitely impacts like whether companies are willing to like accept the volatility or not.
Okay.
And when it's down, when the market goes down, obviously companies have less incentive to go out at that point in time because they're not going to get the valuation that they want. One of the issues that we've seen with quite a few of our clients is that when companies raised money in COVID, valuations were so high. And a lot of times what happens when you get like preferred stock investors in the company, they have like anti-dilution clauses in there. And I think what's happening, and one of the reasons why the market was so slow in 23 and 24 was because preferred investors aren't willing to get diluted yet. But it's gonna come to a time where either they have to come to a realization that it's never gonna get back up to that point that they were at that, like in COVID, or they're just gonna have to wait it out longer so that they don't get like significantly diluted. And it's kind of just like, I guess it's just an investor decision at that point as to whether they're willing to go out at a lower price or just like kind of hold their money in there and hope that it goes up in the future.
Volatility.
Yeah, I mean, I have a bias working in private equity for private equity clients. Is, you know, the exit strategy on IPO is kind of usually the small percentage of private equity. You know, they're looking to sell to a strategic that has cash so they can get their money out quickly. And I think like there's more Berkshire Hathaway models that are trying to be built by either, you know, like Bill Ackman or private equity firms are kind of creating this like 30-year hold or indefinite hold construct. And so...
And by the way, I think that's killing it. I believe in that strategy.
Yeah.
I think that's just whacking the middle market private equity.
Yeah.
Right. Because if you're a founder-led business, you know,
why not?
I mean, why would I go into a fund? And I used to work for 9 years, as you know, in private equity in the middle market. Why would you go there where you're in a 5 to 7 to 9 year period when you can go get even perhaps even better terms and be part of a long hold.
Build a long-term business.
Yeah. And as those guys enter and gals enter, that it's just changing the disposition of the seller, meaning the CEO or the current management team, to opt into that strategy. It's just crushing the middle market, I would argue.
And I would argue, right, that going public, again, nothing against your services and what you guys do, but like, you know, at the end of the day, like I was with the CEO a couple weeks ago, there's 600 million EBITDA, and he's like, oh, we're getting too big to sell to the KKRs and Blackstone. He's like, which of these business units should I sell so that I can go to PE next and do another turn?
Yeah.
Like he didn't want to go public, right? He didn't want to be part of the overhead and the reporting and all the things that you know that comes with that and expectations.
Well, as much as I like doing IPO services, like if I owned my own company, like I would never take it public. Like, I would be like, it's just too many bells and whistles that you have to go through, and it's so much extra cost to that at this point in time. I mean, we've got pretty liquid market. The IPO market in the first place was started because people just needed a way to liquid trade their investments, right?
It was their exit path.
But
It was their
nowadays,
exit
yeah,
path,
nowadays you've
meaning
got,
their personal.
yeah, exactly.
monetization,
But nowadays you've got companies out there that like basically buy and sell on the secondary market, and like your investments as a private shareholder are a lot more liquid than they used to be. So like in my mind, there's not as much incentive to like go public. I mean, there are situations where it definitely makes sense, like what you were talking about. If you really can't sell off parts of your company and you are getting to that point where you need to raise capital, then it makes sense. We see a lot of biotech companies that go public because it's kind of more of a high risk, high reward model. And that makes sense too, because you're like, in PE firms will go in and they'll buy 20 different biotechs, and one or two of them are going to actually be successful. So you kind of have to do more of the public model in that case to be able to get your average return in a way. But yeah, so there's situations where it makes sense. There's situations where it definitely doesn't.
Yeah, the other argument is you go public to get currency to do big M&A, right? And that's a great way to do it. It's harder, and cultural issues with M&A and all that, but so any commentary on what's going on in the federal government right now? And I mean, so I'll call it fitness. Any impact on the job market and uncertainty that's in and around, I'll call it Doge, and not getting political, just in terms of right sizing the federal government. Just a couple data points, right? I mean, the spend of the federal government, my memory's going to test, I think in 2019 was about 4.5 trillion. It's somewhere in the 7 trillion range now, primarily through stimulus and spending through COVID. And if you straight lined that kind of through to 2029, straight lined it as in grew it kind of 3%, you're at what, 6.5. So if you just look at growth from 2019 to say 2029, and you went kind of 2 to 3%, if we do a little bit of, I'll call it, governmental fitness, governmental sort of, getting more fit, we're actually not too far away from where we would have otherwise been at a regular kind of rate. So anyway, it's less about that. It's more just like, what are you seeing as it relates to
Impacts
labor
on
markets and
companies?
impacts on companies? Yeah.
Yeah, so again, like sector focused, I would say consulting firms also, where I have a lot of peers, there was a lot of public sector growth the last 2-3 years.
Yeah.
And that's kind of what propped up a lot of the firms. Look at like a Huron's stock price, right? They do well in
Governmental
times of
work.
recession. Yeah.
Yep.
Now, right, those people are being laid off, tons of uncertainty, jobs, that's where the unemployment numbers have spiked.
Booze in particular, by the way.
Yeah, but there's just so many of these, like firms you didn't even think of, right? Like Slalom and just all the consulting firms that went, when the times were good, into the public markets. We didn't do that ever, but that is impacting an example of consulting and labor, white collar labor. There's a lot of cybersecurity tech companies who really grew on government. And so I think that just like ramps value proposition from the CEO this morning. Like if is not a clear articulation of your financial value and the ROI of your solution, like Elon's coming for you. So, and that's anybody doing services into the government economy. So ultimately, I think you just have to look at what your exposure is. If you're a private equity business, we're seeing a lot of impact in aerospace and defense. People that were serving the Boeings and Honeywells, and those firms are carving out things. They're struggling for cash with the defense budgets kind of shifting to the neocons and the VC based stuff. So there's opportunity and risk, but that's probably the sectors we see the most. And then automotive is, I don't know if this is as much administrative other than not having ARRA and just things that are pushing the incentives on EVs, but the automotive, there's a lot of companies just barely hanging on from a free cash flow perspective. And we're starting to see some carve-outs come out of
those are public companies primarily, spinning off.
Divisions of private equity, where it's just like that EV forecast has been pushed. And so like all the R&D and plants and investment that went in thinking that everyone was going to buy an electric car hasn't been there. And
so it's the full supply chain too. Everybody's who's feeding that industry.
Exactly.
Any commentary on that?
Yeah, I think the only other thing I'll mention is like biotech is another area that could be impacted because
From the
lots
governmental
of
fitting?
government grants in there, and I think it's going to be harder and harder to get grants in some cases. I think it depends on what it is. That's probably a very like stereotypical or broad spread comment that may not be fully true, but there, and then like what you said, government companies that have a lot of government contracting revenue. So like one of the big IPOs that we helped on back in 2019, 2020 was Palantir, and they're like a $200 billion market cap company now. And but they're very heavy government contract, like lots of defense contracts and things like that.
Pretty much all.
So I don't know exactly how it's going to impact them. That, and not saying that they're going to lose all their revenue, but that's just one example. But there's a lot of companies like that out there that have a lot of government contracts and that are defense related or other government related, that I think it's going to be harder and harder for them to get funding and to like actually get contracts secured with the government.
Got it. Great. Thank you. All right, let's go to Q&A. Blake, why don't you take the middle one there, mate, which is, how early do you see companies in tech in particular, right?
Yeah.
Preparing their finance teams for, the operational rigor associated for an IPO. I have a thesis, just a color commentary as you think about the answer. To me, I've always said the thesis, you can get into like you're never ready. You need to be ready from a risk point of view. You need to know what the hell you're doing with your reporting. But other than that, you can pretty much roll, I would argue, as long as you have a plan, a point of view as to what you're going to do in 3 months, 6 months, 9 months. So anyway, maybe part of this is how fast, right? I mean, tech companies move at a quick pace. Why can't they just get into the market now? Like, what are the requirements truly to get into the market?
Yeah, I mean, the true requirements, to your point, like if you're a smaller reporting company or what's called an emerging growth company, there's not nearly as many hoops that you have to go through. You don't have to be SOX compliant and have all this like massive control structure in place. So that takes one of those hurdles away for a lot of tech companies that we work with that are even that are relatively early stage and haven't hit that large accelerated filer type threshold. But to your point, like you're never going to be 100% ready, and if you are, you've spent too much money. On prepping because like you can't address every risk that you're going to possibly come across. So the trick is really like you need to focus on what are the key things that we cannot afford an error on, and then you just risk balance from there. But what you don't want to do, I would say, because this one's specific to finance teams, what I see in the tech industry a lot of times is that the finance and accounting gets completely neglected. And there's
which is really odd.
No investment.
Because
and to some extent it makes sense because you obviously want to make your technology give you the biggest competitive advantage as possible. So you're pumping in all your resources to improve and to like make that technology better. But if you completely neglect your finance, like we've seen some situations where a tech company will come in and their revenue model is just like completely wrong, and it takes like literally, like we've seen companies running revenue on Excel, which is not a good idea. And it takes forever and tons of money to like fix it. So there's certain things that you have to get right up front to make sure that you're not going to become like $100 million revenue company and then all of a sudden be like, we've got to fix every revenue transaction that we basically have in existence because it was all wrong.
But I'll put the banker hat on.
It's not fun.
I wasn't a banker. I'll put the banker hat on. So we got to go now. The market's open.
Yeah.
All right. So Keith, are most of companies coming to the market for IPO PE backed or less than before? Said a little differently, right? I mean, you do a ton of sell side, right? Prep for sale. How much do you see sponsors doing a dual track? Because there's some strategic benefit to the dual track. Private sale to a sponsor or to a strategic versus going into the market just to push the buyer on the other side.
Yeah, at least on the PE side, I don't see as much of the dual track.
You don't? Yeah.
No, they kind of know like once they get to a certain size and who the potential buyers would be. And, they have the private conversations, right, with bankers. So I think I don't see as much dual track, if I'm honest.
Great. Let's see. Exit multiples? The third one. Why don't we talk about exit multiples briefly?
This is a good one.
Yeah.
So I think that I was talking to Houlihan. They're the number one banker from a PE transaction league table, Houlihan Lokey.
Yeah.
So kind of similar private equity middle market things. I think the AI was mentioned as a top 3 reason for kind of killing deals and impacting multiples, believe it or not, which I was surprised.
Killing deals.
Killing deals
Yep.
was their top 3 reason, and obviously having an impact in multiples. So I just thinking about as a founder or CEO that exit strategy and your position there from a market disruption standpoint or potential value was an interesting one.
All right, let's close out. Any final thoughts as it relates to 2025? I mean, I'll start. I actually think that we will, if we were sitting here in 3 to 6 months, the market is going to be humming. That's my theory. I think there's a ton of pent-up demand to exit businesses in the sponsor world, to put capital back to their LPs. All the GPs out there that are, that really want to raise their next fund. I think they try to hit the bid. As soon as there's some settling and less uncertainty, in my view, the middle market just flushes quickly. If anything, because it's been, 18, 24, 36 months of just brutal sort of deal flow, and the ratio between putting money to work and giving money back to LPs has been sort of really to the negative in terms of wanting to raise another fund. So one could make an argument that could put downward pressure on multiples because people are moving sort of through, want to move companies out into the market more. That's my view. So I think we're going to see that in the second or third quarter. What do you guys see? And we'll end on that.
You want me to go?
Yeah, I'm going to round it up.
I would say, I agree with that. I think it's definitely coming.
It's just a thesis.
And from my perspective, since I'm more focused on just like accounting and finance, what I would say is like, just don't delay preparing, because the sooner you prepare, it's going to just give you more time to really evaluate what your company needs and be able to say what do we need to do as a business to be more efficient? Like, what Excel spreadsheets do we need to get rid of? I know that was mentioned earlier.
Yeah.
And what's technologies like Ramp put in place where where it can just make our business run more efficiently. And you can get all these things out of the way that's not just going to help you when you do an IPO, but it's just going to make your business better and make your business more efficient. So like focus on those things while you have the time, because once you get to, we've seen this with many companies, and although it's good for our business because it costs a lot more money, but as a business owner, I wouldn't wait until you have to do an IPO, because then you're like on a very tight timeline and you're trying to cram all this stuff that has to get done into a very short period of time. And it gets very expensive because you don't have the time to really evaluate your alternatives. You don't have time to like say what's really the best for our company.
Yep.
And it just gives you more choice the sooner you start preparing. So that's what I would say is give yourself the choice rather than being forced to spend what you could avoid otherwise.
Got it. Great. Keith, take us home.
The heart versus the mind. I'm going to say that I don't see the rip until 26.
You don't.
Q2.
Q2 26.
Yeah, maybe we see like, on your bar chart, maybe a 10% increase this year, but nothing like market rep. I think just like we need time to just slog through the, I think I checked Polymarket this morning, there was a 25% prediction on 2 interest rate cuts. Yeah. If like companies can post revenue growth this year, even if it's small single digits, and we get 2 interest rate cuts, people will launch processes, the first of the year next year, and then you see those things trade in a big way. So it's just the time and the slogging with the media and everything going on. I just think it's like
going to take a little longer.
Ice, yeah.
Yeah. Well, in closing, thank you very much for your time. You guys are super busy. Really appreciate it. Super interesting. Keith, Blake, thank you.
Yeah.
Thank you, everybody.
Yeah.
Yeah.
You want me to turn this off?
Thank you.
Thank you so much. That was amazing. So as we wrap up an incredible day full of discussion, I'm going to hand it off to Mark to close us out. Thank you all again so much for being here. Thank you to our expert panelists. I think we all learned a lot today.
Good clicker. We have a clicker. All right. Let's hear it again for the panelists. That was amazing. I got to tell you, Guy, when you got up here, I had my E-Trade account up. I was ready to fire away. And then your first slide, I put my phone away. So my wife thanks you. So, all right. So I am thrilled to be here. And I'm also mindful that I am the last thing standing between you and a drink in your hand. So, and I'm fresh out of Concur jokes. So we're going to fire away. And there's just a few things that we wanted to close out with and tell you about that's upcoming with the partner program. And so we want to spend a little bit of time talking through each of those. But before we do that, we just want to say thank you to all of you. Give yourselves another round of applause. Nothing that we do is possible without the work that all of you do. And we are so grateful for you spending your day with us and also all of the partnership that you give to us. And we are so grateful for everything that you're doing. You guys truly are an extension of our team, and we're so grateful for that. So as we dive into a little bit of what's next for the partner program, we want to start by addressing a few key themes that we've heard from each of you. So all the things that we're going to be launching over the course of the next 2, 3, 6 months with the program are all going to be based on feedback that we've heard from you. And we've really heard feedback around 4 key areas that you want us to dive into. First, scalability. Scalability is really important. Of course, managing clients is a top priority. Managing clients at scale is a top priority for you. We've talked a little bit about the advisor console. I want to spend a little bit more time on that before we wrap today. Second, you want better enablement on ramp. You want to figure out how do you keep up to date with Jeff and the product team and everything that you're doing, everything that they're doing. So I'm going to talk a little bit about that. Third, seamless integration matters. You want ramp to work with the tools that you use to run your business. So we'll spend a little bit of time on that. And then finally, you're looking for more ways to grow with us, whether that's through more co-marketing, better engagement with the partner community, more recognition, more access. All of those things are things that we're going to be focused on launching over the next little bit. So the first one, talking about scalability. We understand how important that is. And we are continuing to invest in the advisor console. You heard Jeff talk about this a little earlier. You heard Megan talk about this a little bit earlier. We now have a full dedicated product squad who's just focused every month on cranking out new features that are going to help you continue to scale and grow your business. And if you haven't been in the advisor console lately, challenge you to get in there. You're going to see all sorts of new features that are starting to come out. Better referral tracking, better payouts, better, more streamlined applications, enhanced reporting. There's a lot that's going on there, and we're very excited for what's going to continue to come there. My ask to you, continue to share feedback. We'd love to hear more about what's going to help you continue to grow your business. So share that with me, share that with your partner manager. Any way we can, we'd love to make this a product that you're going to use to help grow your business. Next, let's talk about better enablement. What we find is that for all of you, there's really 3 things that you want to do with Ramp. 1, you want to learn the product. 2, you want to learn how to sell the product. 3, you want to learn how to service the product better. And so that's really what we've gone all in on with the Partner Academy. We relaunched it in January. Since then, we've launched 15 new courses, and we have the first Ramp Essentials certification that's going to be launching next week. And we have, I think, 5 new courses that are going to come over the course of the next couple months. Some of them deep diving on integrations, QuickBooks Desktop, Workday. I was on a call yesterday, the Treasury course. I think that's imminent. That should be landing in the next little bit. So there's a bunch more courses in there. So if your teams or if yourselves want more training on what's going on with Ramp, please get in there, spend some time in there. And if there are things that you want to see more of, please let me know. One other thing, for our accounting partners, we know how important CPE credits are. So we've submitted our application to NASBA. And so soon, you're going to be able to get free CPE credits. If any of you knows how to grease the wheels at NASBA to speed that along, I shouldn't have said that out loud, but talk to me over there. Until then, until we're ready for that, you can get CPE credits through our on-demand webinars, but we really want to continue to lean into enablement, CPE, all of that to help you grow your business. Finally, integration. Seamless integration matters not just for your clients, but for every single one of you and how you grow your business. And so you want Ramp to work with the tools that you use. So we are super pumped to announce additional integrations that we've got coming with the tools that you use to run your business. Things like iWin. Where are they at? Where's my iWin guys at? There we go. Thrilled for you guys. Thrilled to be partnering with you guys. Carbon, Carta. These are firms that these are tools that you use to run your business, and we're going to continue to lean in there for our accounting partners. With iWin and the Carbon integrations, they're going to help you with client billing, spend management, better financial workflows. For our finance partners, again, we're going all in on helping you integrate with Carta. We know that's a really important platform for you. You're going to be able to get clearer views into your portfolio company spending, give you better visibility, make sure that all of your firms are audit ready when the time comes. So we are thrilled about these integrations. If you want to be part of the early releases or the beta groups, again, let me know, let your partner manager know. We'll get you set up with the right people. Finally, falling over here. Finally, you want more ways to grow. That's really important. And so we are rethinking our partner benefits, our tier benefits, and really focusing on recognizing you for the work that you do. And we're reimagining the partner tiers. So what you're going to see here is for our accounting partners, we want to give you more ways to grow through the partner tiers. And so no longer are you just going to get recognized on number of clients that you refer to Ramp, but you're going to get recognized based on the size and the impact of those clients as well, giving you more opportunities to grow through the tiers, getting more benefits as you grow with Ramp. We're introducing a Ramp or a champion tier program that's going to reward those partners that are continuing to drive the pace and continuing to drive momentum. Additional marketing development funds, MDF, co-marketing, lots of different benefits that are coming on that. For our private equity, our venture capital, our services firms, we're going to be launching a whole new tier program just for them. And so with their own unique benefits and tiers and programs. So there's a lot of interesting, exciting things that are coming on that front. Keep an eye on your inbox. Next couple weeks, we're going to be announcing that. We're going to give a lot of details on exactly what the tiers are, how you earn them, what are the benefits. But we really just wanted you all to have a flavor of what's to come. You made it. Last slide of the day. Give yourselves a round of applause. None of these investments that we're making come without your help and without your feedback. So continue to please keep that feedback coming. I want to say a few thank yous. First, all of our speakers, all of our panelists. That was amazing. Our partner marketing team, folks like Shadi, Pamela, Christine, Al. Am I forgetting anybody? When we decided to do this about 4 or 5 months ago, you're never quite sure how it's going to come together. You're not quite sure whether folks are going to show up, and you showed up. This was incredible. We're going to be sitting here 5 years from now when this group is 50 times this size, remembering the good old days of that time we had the Partner Summit actually in the Ramp office, and excited for that. But again, thank you for everything that you do for us. In the spirit of continuous feedback, go ahead and scan this QR code, links to an NPS that you can give us some feedback that we can use to get better. But with all that being said, thank you, and let's get a drink. Thanks, everybody.